A day of reckoning could be imminent for home buyers who locked in record low interest rates at the height of the global financial crisis. They're facing a big increase in mortgage payments as their fixed rate periods come to an end. Variable rate borrowers have already been feeling the pain in recent months. Andrew Robertson reports.
In the months following the collapse of Lehman Brothers in 2008, interest rates were slashed and the federal government introduced 2 stimulus packages. First home sales soared, with many people stretching themselves to get in while mortgage rates were abnormally low. Mark Bouris was the founder of Wizard Home Loans and now runs Yellow Brick Road Group. He says the chickens are coming home to roost.
They are the aspirational Middle Australia, the people who drive this nation. They are the backbone of this place. They responded to fiscal stimulus. They got the country back up and running, or partly helped get the country back up and running. Today, they are paying for it in the neck.
The numbers explain why. For example, from April to October 2009, the typical variable home loan rate was 5.49%. Today it's 7.87%. The 3-year fixed rate over the same period in 2009 was between 5.99% and 6.59%. Today it's 7.58%. Which means people who bought with a variable rate loan have seen their mortgage interest payments rise by 43%. Those who locked in the low rates are also facing a hefty increase when their fixed rate period ends.
Yeah, $100 on an average $300,000 loan, it's going to be $100 a month extra. That's going to be a big hit.
A big hit too for businesses who rely on discretionary spending as households struggle to make ends meet. And lenders are starting to feel the pinch as well.
There's been an increase in the rate of delinquency in those mortgages, which started about 6 months ago. And they typically take out variable rate loans rather than fixed rate loans. So we've already seen an increase in the delinquencies, and Commonwealth Bank reported that last month.
To make matters worse, there are 2 more dark clouds hanging over the housing sector. The first is the Reserve Bank, which is doing little to dispel fears interest rates might still go up.
As interest rates increase, it's going to place more pressures on everybody's income or on their monthly income, and that will just impact more so on people's arrears. And we'd probably see more impact from an increase from the Reserve Bank than what we would see from people coming out of their fixed rates mortgages.
The second dark cloud is the rising cost of money on international markets as sovereign debt issues take their toll again, which means banks will have to pay more to borrow there.
The banks hold about 6 months of liquidity on their balance sheet, such that they don't need to go to the markets for about 6 months.
However, if the price of money doesn't fall in that time, CanStar Cannex's Mitchell Watson sees only one outcome.
We have seen precedents going back only, say, 24 to 12 months ago, in that banks will pass on those costs should there be an increase which they're unable to maintain at their current interest rates.
In other words, more rate increases beyond any from the Reserve Bank.